Ravi, are we good to go?
Yes, we can start. We
Okay.
are live.
Good evening, everyone, and welcome to this special webinar for HDFC Securities clients with our today's market wizard, Mr. Vikas Khemani. So, Vikas Khemani is founder and CIO for Carnelian Asset Management. So, welcome, Vikas, to this special webinar with HDFC Securities team. Uh,
Thank you.
so,
Thank you, Neeraj. Thank you for having me.
Yeah, it's a
Good
pleasure
afternoon
to
to all.
have you on the call. So before I start the call, I would like to have a disclaimer that whatever discussion we'll have with Vikas, they are not recommendation or advisory for anyone on this call. You may consult with your financial advisor before making any investment decision. So with that, I'll pose my first question to you, Vikas. So forensic analysis is the USP of Carnelian Asset Management, and it is the new concept which was introduced by you. So please take us through this and how do you use it in your fund management?
Sure. Thank you, Neeraj, and good afternoon to all of you, and lovely to kind of chat with you. So maybe before I lot of new clients will be there, and maybe I'll take 1 minute to kind of give a little bit introduction of Carnelian, and then get you into the investment philosophy. So, as some of you might know that Carnelian we started in 2019. We are about 6 years old. As a firm, when we started with 150 crores, but today we manage close to 15,000 crores across various strategies. And so we are one of the fastest growing AMC. And today we work with very large leading family offices of the country. Have 85 people team, offices in 9 cities. Work with about 5,000 odd clients and across various strategies. We have delivered superior risk-adjusted return over last 6 years, and that performance which stands out, is a result of our investment philosophy. And that in an investment philosophy, as you rightly said, the forensic research is a part of it. But let me elaborate a little bit more before I get to the forensic research. You know, we as a firm, we basically believe that risk management is an integral part of it. And there are, of course, everybody wants to make money, but to make money, risk management becomes a very, very important part of it. And we believe that, there are two very core fundamental beliefs around risk we have. Number one, you should take risk only when the risk reward is in favor. And secondly, you can manage the risk from only when you know the source of risk well, where the risk coming from. So from that point of view, we divide risk into three parts: type A, type B, and type C. Type A is the risk of permanent loss of capital, meaning after you invest, you lose 100% of your capital, 80 to 100% of your capital. Source of this risk is only twofold. Either you bet on an inferior quality of the management, खराब आदमी पर रुपया लग गया, or you bet on a business which is prone to disruption. तो ये दो चीजें अगर आप अवॉइड कर लेते हो तो you will not lose your capital permanently. And that is where our forensic research capability comes into handy. This capability we started in 2007 when, as a team, we were part of Edelweiss. First time in India, we started this research capability, which became very popular in the institutional investing class. So in this, what we have built many systems. If I put a ticker of a company, it pulls data from different sources and tells us what are the red alerts. कि इसमें problems क्या-क्या हैं. Sometimes it could be about business model, sometimes it could be accounting practices, sometimes it could be related party transactions, sometimes it could be anything else. And then we follow it up with plant visits, speak to employees, ex-employees, vendors, auditors, do a complete 360-degree assessment of the management quality. Because if you get that right, at least you got the part of that management quality, so you will not lose 100% capital. Then you have to only get the business cycle right. Right. So type A risk is something we will never take, which is a permanent loss of capital. And that is where our forensic research capability comes in very handy. And we have done almost PhD on this because we have been doing as a team for almost close to 20 years, and we have kind of only evolved with every passing year on this capability. You're on mute, Neeraj.
Yeah, sorry. How has this forensic analysis helped you in building your portfolio? If you can quote certain examples which helped you avoid a company which was looking very promising on paper as far as the numbers are concerned, but because of this analysis, you made a right decision in the portfolio.
So there are many, cases. I will not take the name, but I will give you some constraints. So, like there was a dairy company which we were, analyzing. A lot of institutional investors own it. Almost close to 30 to 40% institutional holding is there in that. And when we were studying, this is the industry we are anyway very, cautious about because there's a lot of cash involvement which happens in this. So we double down our research. So we increase our forensic research on this. And so we spoke to one of the ex-employees of the company. And when we asked him that, why did you leave the company in 6 months' time? He said there were, parallel set of books of account. And that gives us basically very clear alert that this is not the company to be invested. And that company has not generated any return for 10 years. Uh, and despite that, they have institutional shareholding. So I believe that many people can fall into trap of that. Secondly, when we do analysis, quality of the business analysis through forensic research, typically we don't like there are many companies which have off balance sheet items. Well, they take the liability off balance sheet, and then you assess that what kind of risk can come from that off balance sheet item, right? So, you do lot related party transactions. Whenever there are huge related party transactions, it gives us alert, and then we kind of avoid those kind of situations. So there are many, layers to it. Uh, at times, you may not be able to say that this is 100% wrong in this company, but you get red flags. And our view is that whenever you get red flags, you avoid them.
Great. I'm sure. I mean, this is a very good filter to have, and this would have helped you avoided some really good names which are looking strong on papers, but had red flag that you rightly mentioned. So within HDFC Securities clientele, we have seen a lot of demand coming for your shift strategy, which is the popular plan within the HDFC Securities customers. So take us through that. How do you manage the strategy and what is so unique about it?
So shift strategy, as would know that we started in October 2020, 6 months after pandemic. And when we noticed two very big structural change happening in India, which are going to be decadal in nature, namely manufacturing and technology. So, we said, why not? And these are two big shifts. That's how the name of the strategy also comes, shift strategy. And we said, let us now, build a portfolio focused only on these two big trends. And as you would know that in last 4 or 5 years, in 2020, nobody talked about manufacturing and technology. Today, I think probably most people talk about it. So, and the partly it has played out also. So we think it's a very long-term trend, long-term theme, long-term opportunity. Because in India, the manufacturing GDP is only 16% of the total GDP. It's expected to go to anywhere between 20 to 25% over next 10 years. Now, it's a very big opportunity. So whenever this kind of trends shifts, happen, you see many opportunities coming. So this strategy invests up to 75% into manufacturing related plays. And when I say manufacturing related plays, it means what sits between import substitution and export oriented opportunities broadly in the sectors like auto component, specialty chemicals, API, CDMO players, then in textile garments, capital goods, defense, electronics manufacturing. So whatever, across many, even consumer electronics, consumer goods. So across the spectrum of, it's not one particular, when I say manufacturing, it's not a particular sector. There are many sectors within the whole broadly theme. Idea here, the theme we are playing out is that import substitution or export oriented opportunities. And the second part of where 25% is on technology, where we play out broadly in the company which are benefiting from the new wave of the technology transformation. So like, for example, ER&D is the next growth area. So we have some companies in that, some of the, product companies which are now scaling up. India historically were only in the services company. So here what we don't buy is large cap IT companies, but we buy here companies where there's a high growth possible of mid-teens to early 20s, over next 3, 4, 5 years. And those kind of companies we are buying, they could be in the new tech space, they could be in the the current services space with high growth potential, or they could be in the product space.
Great. So there are two new themes which have caught a lot of attention in the market. One is obviously the defense sector, and the second being AI. So what is your views on these two new emerging themes and any allocations in these two
So
segments?
which was the first one you said?
Defense and AI.
So of course, defense is a big opportunities. We have, I think, one indirect play on defense, but currently a lot of challenge in the defense plays in terms of the valuations. So, how do you kind of value lots single customer risk, but high valuations? So we kind of be used to on it, but I think we are now kind of out from most of our portfolios. Uh, so that is one. As far the impact of AI on the technology is concerned, We have a slightly different view. Everybody thinks that AI will disrupt IT services, but we think AI will only enhance IT services industry. For the simple reason, see, if you just look at last 20, 30 years of trend, every time there's a big technology disruption happens, you see IT industry only expanding. When it started with Y2K, that time total industry size was $10 billion. Many people wrote off that after Y2K, what is there in Indian IT services? But today, from $10 billion to 200 plus $billion, it moved to ERP, it moved to digitization, it moved to cloud migration, and so more and more technology is there in everybody's life, including organizations. And IT so and the way to understand that is that product companies can sell products, but solution implementation is done by the IT services company. So I think the need of IT services company will always be there. The only thing is, in fact, AI can help them in terms of better implementation cost. So you may not have to hire so many people to implement them. But the solution oriented approach, so IT has over the years moved from body shopping to solution oriented companies. And in the solution oriented companies, as long as solution is needed, your delivery cost does not play as much as a role. In fact, some point in time, it might be a little bit margin accretive also in a shorter term. Eventually, it will find its own way. But so I do believe that IT services will grow. But within that, I'm not saying that every IT company will grow. Large companies will find difficult, might find it hard to grow. So, like in 2000 cycle, Infosys, Wipro, Satyam got created. In 2009 to 20 cycle, HCL Tech, LTTS, LTI, Mindtree, Persistent, all those companies became 20 to 30x, right? So in this cycle also, there will be many companies which will be part of this growth journey, where they will grow faster than the existing companies. And in 9 to 20, Infosys did not grow, Wipro did not grow, but other companies grew. So we will identify those companies will grow faster than the industry.
So I was going through your recent newsletter in which you have spoken about fact to fundamentals, and you have mentioned the three companies in that. So your views on the internet or the digital themes company.
So yeah, so I think we always write good letters. So like in 2021, when every not saying fad, FOMO, fade. That the fad is going on, people are investing out of FOMO, this will fade away. And we said risk reward of investing in these companies in 2021 did not make sense. But fast forward, as 3, 4 years passed by, most stocks got corrected. Two, three things happened. A, price got corrected. Secondly, all these companies, because the free funding was no more available, had to pivot from burning to earning. So earlier they were focused on burning, and then they had to focus on cash flow and earning. And that pivot, I think, made those businesses far more better likable by us. So the platform plays are always important. There's no question on that. But the point is that you need to write metrics on this. We could see some right metrics playing out in some of those platforms, competitive intensity coming down. And I think that made us kind of quite positive on them. And so we are now looking at, it's not that we buy everything blindly. We look at and try to understand individual risk reward of the individual company, and then only we invest. So in that note, we outlined very same thing I was telling you.
This landscape has been changing quite at a rapid pace, if I may say so. Because first it was e-commerce, then it graduated to instant commerce, and now yeah, quick e-commerce to quick commerce to instant commerce. Now a lot of sale is happening on Instamart and your Instagrams and all. So in such a scenario, how difficult is it as a fund manager CIO to make a view on the company with a view of 3 to 5 years? Because there is always a scope for disruption coming in.
So see, look, again, nobody knows for sure what will happen. You try to understand. That's the reason, you have to understand management team, their ability to pivot if the environment were to change, and also, whether they are funded or not, what are their broad. So you try to understand that what kind of competitive intensity can come. So all those things we do and try to focus and then take a view on that. And in my opinion, it's not like it's not 100% probability, but that's like any other investing, right? When you do it, uh, uh, any business can get disrupted, but you try to assign the probability that what can happen, what are the potential. And if we believe that this can be potentially threatened or disrupted, then we don't get there. Then we avoid them. So that's a very big risk then. So we will never want to be in the invest business which can potentially be disrupted.
Your views on the market, because I've seen your the recent interviews in which you've said that US tariff is something which is has a short-term impact, but I would like to know what is your short to medium-term view on Indian equity markets, and what are the factors that will be essentials to keep a track on?
Very good question. So I think, see, the Indian, I've been very, very positive through this last 6 months of the downturn also. And I do think that, Indian markets are in a very, very positive space for a simple reason. Last year, when Indian equities peaked out, that point in time, if you remember, previous RBI governor had, in order to defend rupee, created huge amount of liquidity squeeze in the system, which got coincided with the general elections. And both these things put together created a huge liquidity strain in the companies, and that impacted corporate earnings with a 2 quarters lag. But once the new RBI governor came in December, he was very clear that he pushed liquidity in the system, brought the interest rate down, and from the day one, he's been saying, "My focus is on growth right now," including last policy when they have taken so many measures to boost the credit growth. So that's a very clear, secondly, government is doing GST cut, income tax cut, infrastructure spending to boost economic growth. So when both of them are, what worked against in that limited period has turned positively. So our view has been that in the tariff news, market ignored these positives, but these positives were at play in the economic level. And hence we believe that earnings are going to be solid. I don't think there's going to be any major, in fact, there will be upgrades happening in the earning cycle. Liquidity has been strong. We think next year even foreign liquidity will be very, very strong. And as a result of that, when you believe that liquidity and earning both will be positive, markets have to do well. So my view is that, in next 12 months or so, in Nifty should be between 29 to 30,000.
Great. Now, what is your current cash holding in the overall portfolio, and what's your strategy when it comes to volatile market with your cash component?
We don't take cash calls for the simple reason, I'm bullish on the stock markets. So why would I take cash calls? So we are fully invested. I mean, there could be some cash here and there as a transition when we are looking to buy stocks and waiting for the corrections and all those things. Those are things possible, but we are not holding any cash call, and we don't mind volatility as a short term this thing we do, because short term risk you can never manage. They come from the sources you don't expect, they come from the time when you don't expect. So only way to manage, risk is to have a long term perspective, and if the environment turns bad, then your company should be able to withstand them. They should be able to come out of the bad environment on the other side of the, period, healthy and strong. Those are the kind of companies we look at, and that is basically determined by the quality of the business model and quality of the management team. As long as these two things are there, it's fine. So we manage our risk actually in selecting the companies and selecting the business models which are far more resilient, far more, robust to withstand any tough time. Other than that, I don't think, much short-term market volatility, price-related volatility, you can do much about.
With data becoming so much accessible, I mean, there's a lot of data flowing not only for India but across the globe. So, in that scenario, how do you see India placed among the emerging economies, and which is the other country other than India that you find exciting in terms of the investment opportunity?
Data is obviously going to be there. There's more and more data, more and more. I mean, India is anyway largest producer of data, and business models are, getting ready on that. So I think, data is going to stay here. Like you, I'm sure HDFC Securities has much more data than it has ever before. So incrementally, lot more, data dependency is comes about. That brings efficiency. That brings a lot of objectivities. Every business has to evolve. So it's not only specific to a field. And I think India, is also innovating well. India is also progressing well on every aspect. So I don't see much, and I believe that India is the best market opportunity over next 10 years. Um, I think we will, if I were to talk to you in 2035, I believe that India would be one of the best market in 10 years.
Any other country other than India that you where you feel the global outflows are moving?
See, I'm not expert at globally. I do believe that US has kind of seen the best, probably risk reward of remaining invested in US is not there. To some extent, China can look good, but I'm not a big believer. I do believe that China has its own risk. I think, like I said, once you have the best market at your doorstep, why to look here and there and confuse yourself? And even if you, let's say, tomorrow decide to outside, if you put 5% of your money outside, how does it matter? It will anyway not impact on your portfolio. So I would rather, not, I would rather do what I understand well. I would rather do where there are controllables in our hand. I mean, in China, I don't understand anything, or any very few people can understand China. So why would anybody spend time and energy doing that? So I think I would say remain invested into India.
In your shift strategy presentation, you have also spoken about China plus one strategy. So, with in context to that, which are the industries or sectors that you feel would benefit?
So all the strategic investor industries I spoke earlier, whether it is chemicals, specialty chemicals, auto components, consumer electronics, textile garments. So all of these were basically what India was importing mostly. Those CDMO is a very big opportunity. So like, those are many such opportunities will come out. Basically, we import about $400 billion of goods from, so I think anything which replaces that is China plus one. Then secondly, world imports a lot of goods from China. So anything that, we can replace for us export, but replacement from China plus one. So it's a combination of both and it pans across whole lot of industries. Some of them I mentioned.
There has been a shift in terms of the promoter identification also. Now, because now there are clearly two categories of promoters. One is the old age style where you had established track record, long tenures of setup, good order books, and I mean big management team. On the other hand, last 10 years we have seen India becoming an entrepreneurial hub and lot of startups doing well and also getting listed. So do you find any key change in terms of the attributes of promoter when it comes to new age and old age?
Any economy, whenever it transforms, fortunately today in India, lots of opportunities are opening across various sectors, across various locations. So first time you will find in India, many companies are growing fast, even in the interiors of the country, even in the small cities. And they are not only thinking small because of the connectivity, air connectivity, infrastructure, road connectivity, and telecom connectivity. Today, what information you and I have, road access you and I have in Bombay, somebody in Rajkot, Surat, Coimbatore, Ahmedabad, any small cities also have. What we are seeing is that many of those cities are seeing explosion of companies, which are growing fast. So whenever you see this kind of growth, because our growth is very widespread across various sectors. So we are seeing an entrepreneurship blooming in the country across the width and depth across sectors. So whenever that happens, obviously, it will come from the stables, the people who've never been there in the markets. Hence more IPO, hence more and more companies are doing well. Hence the width keeps on getting increased. So I think it's a great sign of a mature, high growth economy. It's a great sign of economy which is progressing in a very, very balanced and a wider manner.
Great. It will be unfair on my part if I do not ask you questions on gold and silver. So while there has been a lot of buying by the central bank, and that was one of the reasons why there was a rally towards gold, but still I would like to know your views on gold and silver from here
See,
on.
look, I'm not expert on gold or something, but I do believe that it's like anybody else that is happening because the central banks are diversifying away from dollar. It's a broader part of de-dollarization. Now, whether it will do from here, well, I don't know. I think most of the gains are was behind, but who knows? I know one thing that equity is an asset class, which is earning asset class, which yields something, right? It is not only store of value. So I always believe that superior wealth is created in a asset class for a long period of time, which is generating, yielding, growing. And hence, I always believe that equity is the best asset class. And that's how I spend my time in the entire career. Now, there's no way to figure out what period of time gold will do well. I mean, a lot of people around COVID believe that gold will do well. For a very 2, 3 year period, it didn't do nothing. It didn't do anything, right? So suddenly we saw a big pop coming. So yeah, this is very hard to for kind of, and I'm not expert. But I do believe that, my broad little understanding, whatever I have, is that I think large part of the game is done. Probably it will consolidate from here.
How would you rate current IPO frenzy market? Because there's a lot of craze. I mean, you see every week 5 or 7 companies getting listed. So if you have to compare this scenario with the markets of 2004 to 2008, where somewhat similar situation was around. So do you see the right valuations for these IPO companies, or it's more of a PE investor trend which has kicked in last 10 years, and now everybody wants to get in because they've spent good amount of time with the promoter.
So I think, see, IPO is part of, again, a sign of economy which is growing, evolving. Like I said, many companies are coming with and that. So obviously, when many companies are coming, they will have to access to the market. At the same time, the hard reality is there. When markets are good, a lot of companies tap market and euphoria happens, and poor quality companies also get access to the market. My guidance, our approach has always been that look at bottom up approach. Don't get carried away by the euphoria. Only when you understand risk reward of something, then only do it. Otherwise, otherwise just don't do it. There are some very interesting company which comes through the IPO. Our general approach is that most of the companies are coming fully priced, and hence we avoid at the outset. But within that, if something we get very interesting, then we tap into it. Otherwise, we just stop it. And I don't think, fully priced IPO should be bought. Investor do buy, euphoria happens, and our job is to stay out of that euphoria.
I mean, when I started my career around the early 2000s, it was a that P is a key indicator to identify any company. But in today's time, it is said that P alone is not a good indicator because India is an evolving market. There is a lot of scope for growth. So high P valuation does not mean that the company is expensively priced. Your views on this?
See, again, P alone is not a right measure, while P is an indicative thing, but I think general right value of the core, most solid value is that this DCF, discounted cash flow value of the companies. And that's also, again, very lot of variables. So it's not like it's a scientific thing you can arrive at a solid value because there are a lot of assumption which goes into arriving at DCF. But having said that, I think what happens is that generally what tool we rely is more than P peg, P to growth. So we are very comfortable between 1 to 1.3 time peg ratio. If the company is growing at 30%, we don't mind giving a PE of 30 times. If a PE company is growing at 20%, we don't mind giving a PE of 20 to 25 times, right? If somebody is going at 40 times, then we don't mind giving a PE of. So that really depends on the outlook of that. And many times what happens is that many companies go through a huge capex, and the growth is over, first 1 year zero, and next 2 years will be high. So in the next 1 year, it looks very expensive, but suddenly, companies change. So like for example, when we bought Newland at 1800 rupees, it was, I think, 40 PE, and today at 16,000 rupees, it is, about 30 PE. So, that kind of things do happen, because of the sharp rise in the price to earn, the sharp rise in the growth. And at times, it is hard to model the growth of companies. But, that is what I think the research is all about, where we end up spending time.
Which are the key sectors where you would have your maximum investment in shift strategy? Which are the sectors or industries that where you would have your investment?
I think, again, largely we have fairly large exposure to auto component, manufacturing, so it's CDI, CDMO and APIs, pharmaceutical, we have very large exposure. And we have capital goods, industrial segment, we have very large exposure. So, within, and then of course, technology. So there are broadly 4 buckets where we have very large exposure from a sectoral perspective.
Between banking, IT, and consumption, given a choice, which one would you choose and why?
Banking, IT, and
Consumption story.
so again, since I'll tell you, this is not about sector. We don't get fascinated by the sector, though banking will do better from a large. So banking will do far more faster growth. Consumer will be so followed by that, and IT will be followed by that. But again, if I told you 5 years ago that banking looks good, and you went and bought HDFC Bank and not ICICI Bank, your outcomes will be very different. So, or you bought Kotak Bank and versus ICICI Bank, your outcome will be very different. So I think ultimately knowing sector is not as important as is the company. And within the sector also companies are, so we always say that focus on bottom up companies talk. Of course, you need to know the broader tailwind of the sector. I'm not saying that, but eventually your investment outcome is based on the companies.
Great. So that sums up my today's webinar. But before I conclude, I would like you to give one message to all our clients who are why one should look at Carnelian and what is the strategy that one should invest in.
So I think, like again, I said Carnelian, we have a very differentiated investment philosophy. Risk part, we are very, very conscious. We don't take stupid risk. We don't get carried away by the euphoria, by the what general trends are. We think beyond the broader trends, in our own bottom up thinking. We have historically identified companies where we can get both earnings growth and valuation re-rating, what we call magic stories. That is our specialty across all our strategy, whether it was Bharat Amrit Kal Fund versus shift strategy or compounder strategy. We have always tried to kind of find companies which are very, very sort of, different. Risk reward is in favor. For example, we bought Aditya Birla Capital at 100 rupees when nobody was buying. Today, in less than 3 years' time, it is 330 rupees. Right now, this kind of you will find why will you not buy? We bought ICICI Bank at 280 rupees when nobody was buying. And that was our single largest holding when we bought. So I always believe that returns come out from thinking differently and in some sense, so we have as a firm very different thinking capability. And I want to show you this. I mean, is my slide present visible?
Just hold on. Yeah, now it was it's
It
coming on the
is.
screen. Yeah, it's visible
It's
now.
coming, right? So if
Yeah.
you see our strategy, right, over the years, we have generated superior alpha over a long period of time. Our capital compounder fund, which we started, in 2019, has delivered 9.3% alpha per annum for last 6 years, 6.5 years, right? Amrit Kal fund, which we last year started when the markets were difficult. Despite that, we have generated, 11% return and 4.5% alpha. Shift strategy, all that we've had again a great, of course, last 1 year has been difficult for this strategy because of the uh, uh, difficult markets, especially for the mid and small cap. But we are quite confident that we'll recover it back. Contra strategy delivered again 28% CAGR with alpha of 15%. So constantly, time and again, we have delivered, superior alpha. And the reason for that is our investment philosophy, our ability to identify trends ahead of the curve. We started buying PSU banks in 22 when nobody was buying. Last year, we added again PSU bank. Now PSU rally has come, but we again added there. So all those things end up, adding to the alpha. So we believe that investing is not really very strong, straight cookie cutter approach. You have to understand risk reward of individual stocks, risk reward of how do you make money? And we think, how do we define risk reward? That if your hypothesis turns out to be true, you should make a lot of money. But if it doesn't turn out to be true, you should not lose much money. So per unit of risk you take, you should have multiplier return. And that is how we think about our investing. And that, in my opinion, is a very, very differentiating approach when we build our portfolio. Of course, we will also make mistakes. We will also have difficult times. I do believe that over a 3 to 5 year period, we will deliver alpha, we will beat markets handsomely, like how we beat in the past. So, whether you invest into with us in compounder PMS or Bharat Amrit Kal Fund AI or shift, PMS, for us or bespoke portfolio, for us, it's all same, approach is same. Of course, each portfolio has different mandates. So we construct portfolio around those mandates. And we are quite confident that, we will deliver superior alpha to our clients over a long period of time. So, and if you have any query, please feel free to reach out to us. HDFC Securities is a very, very sort of close partner for us. Very happy to sort of, to the partners of HDFC Securities, clients of HDFC Securities, we have a special access. So whatever help you need, reach out to our team. We will be there to provide that support.
Definitely, because I think there are about 250 odd PMS in the country and 75 odd AIFs. But as HDFC Securities, as a part of product team, we recommend only the top 3 or 4, and these top 3 or 4 are not only by performance or by AM, but basically merit of the fund. And Carnelian definitely has a spot in that. And there was a lot of queries which were coming to us that we would like to know more about Carnelian, and that was the reason why we requested you to be with us. So thank you so much for sharing your thoughts and I mean telling more about the Carnelian and the way the customer funds get managed. we will make all our endeavor to ensure that most of our client portfolios have a flavor of Carnelian funds and have a good investment journey along with you. So thank you
Thank you,
so much
Naren.
once again.
I really appreciate your time and taking trust in us, recognizing us, and putting into that top three portfolios. And I do hope that we live up to your trust and your trust and your clients' trust, and build from here in a big way.
With that, I announce the conclusion of this call. Thank you so much for joining. Have a happy investment journey. Thank you. Bye bye.
Thank you.